Welcome back, everybody. It's time to look for new positions and track some more transactions, so let's get right to it. All right, it's been a while. We need to find out where we stand with our investments or with our purchases with BITO. Here we are logged into Thinkorswim, the paper trading account, and we're looking at the account history. And it has been a while since I recorded the last video. It looks like September 7th or 16th might have been the last time. I have been selling some cash secured puts and covered calls, and I actually started selling them closer to at the money, and I ended up having to roll them. I think, let's see, that one I rolled it once, rolled it twice. So we have a few rolls or a couple rolls that happened, and it looks like some more cash secured puts were sold. So in any case, we have several transactions that we need to go track in the application. So let's go over there and start doing that right now. Here we are logged into the web application at myatmm.com, and we're just sitting on the dashboard. We need to go over to the cost basis screen, make sure BITO is selected, which it is. And let's see, we need to get the transactions up on the screen. Let's see if we can do that right here. There we go. All right, so we have them up on the screen. So the one I have highlighted looks like it was the cash secured put assignment, and that one is logged. So we can see 2050 and the 2050 right here. So the next one is we sold a cash secured put. So we need to track that. That's not in here yet. So add a new position. The date back on this is September 16th. So let's come back to September 16th. Select that. It was a sell to open, and it was a put. The number of contracts we did was just one. The expiration on that was September 20th, 2024. So right there, the strike we did it at was 18 and 71 cents. All right, click save. Then it comes down to the proposed records. So 71 cents, the commission was 65 cents. The fees was 2 cents. All right, so move that down and then click the save button to save it to the permanent transaction history. So the next transaction is we sold 12 covered calls, it looks like. And again, the transaction date on that was September 16th. Come back and change that. It was a sell to open, it was a call, and it was on 12 contracts, expiration being September 20th. Strike 19, we got 6 cents per share on that one. So the commissions was $7.80, that's accurate. And the fees though were 8 cents. So let's change that. Move that down, click save. So now that's saved to permanent transaction history. And then next transaction, it says diagonal, and really all that is we rolled. So we rolled, let's collapse this. So we rolled the calls, we rolled those forward a week. So as you can see right here, we took the September 20th and we rolled them to September 27th. So what you do in the application, all right, so what we do is we select roll position, and we don't have to worry about this price because we're not going to have a closing transaction. We're just going to have the new transaction because we don't have to do the closing transaction because Thinkorswim rolls them up into the same transaction, making it a little easier. All right, so the roll date is September 20th. Again, it's a sell to open. It's also going to be a call. It's going to be 12 contracts. And we're moving September 20th to the 27th. Right there, the strike price. And also, what I did is I rolled it from, not only did I push it out 1 week, but I also rolled it from a $19 call to a strike price to a $19.50 strike, because what had happened is the stock price had moved up above the 19 and the 19.50, which was the reason why I was rolling it. So this was to capture or to move it up to try and keep up with the price of this stock. So what this allows us to do is it allows us to basically sell a covered call closer to at the money to get more premium, but this is to basically protect it. As long as you leave enough extrinsic value, meaning you roll the option forward enough in time to where there's, I I go by basically having more than 10 cents per share of extrinsic value in the option. As long as you keep the extrinsic value high on the option, you most likely won't get assigned. It's not impossible to get assigned, but somebody would have to take a significant hit, meaning they'd have to absorb that extrinsic value in order to take it. So that's why I try to keep the extrinsic value high. Now, if you let the extrinsic value go down to zero, which the extrinsic value is just time value, if you let that go down to zero and there's only intrinsic value, then the chance of assignment's much, much higher. All right, so let's see here. The price, so the strike was 19.50. The price we got for it was 19 cents. That's a 22.28. So we click submit. That creates the new record. We can delete this old one and click save on this one again to get the proposed record down here. So now it's 2.28. The commissions right there you can see is 15.60. So let's enter that. And the fee is 15 cents. Let's move that down. Click save. All right. So the next thing we did is it looks like we sold a cash secured put. So let's look back at this one. So this one must have expired out of the money, which makes sense because we rolled this one, meaning the stock price was above 19.50 and this is at 18. So that expired worthless, so we can get rid of it and close that too. So we need to create a new position. This one was opened on the 23rd of September. All right, back there is a sell to open. It was a put. It was one contract. The expiration is September 27th. Strike price 19.34 cents is what we got for that. Click save. Make sure the commission is correct, yes, and the fees were 2 cents. Click the helper button, click save. All right, next, I think this is the last transaction. Yeah, the other two are something I goofed up and did that transaction in the wrong paper trading account, so it was just some 0 DTE expiration test I was doing. All right. So the last transaction is we again rolled that call. All right, so let's collapse this, come back to the call. So we rolled it again a second time. And this time you'll notice, see, okay, so the first time we rolled it from 19 to 19.50, and then the second time we rolled it from 19.50 to 20. So we're slowly increasing the covered call strike price up to keep up with the rising ETF price. So we don't get early assigned, so we can still collect the most premium because we're close to at the money. And this is the way you can do that. All right. Where are we at? So we need to roll this position. Transaction date was September 27th. And I may not have picked the correct timing to do all these. Is really just to show you the concept and how to track it in the web application. So the expiration on this is we moved it from the 27th to the 25th of October. So we pushed that out almost a month. All right. And so we pushed that to 20. And we got 16 cents for that. So click submit. Again, it creates the record, so we can delete this old one. Click save there to move it to the proposed transactions. So it was 192, and the commissions was 15.60. The fees was 16 cents. So move that down. Click save. All right, and so now we're done. And as you'll notice, so the stock price is kind of funny. Right now, you can see the last price it traded at this past Friday was only 19 bucks, 18.96. So we had been rolling those covered calls from 19 to 19.50 and then 19.50 to 20, and see now the price has come back down. So now the covered call has expired worthless because the 25th was this past Friday. So that expired worthless. So we can go ahead and remove it. And the cash secured put that we had on expired on the 27th of September, so that expired worthless. So we can close that too. So now we're back to square one. And so we still have the 1,200 shares. We've still been collecting premium the entire time. And so we're basically ready to look for another covered call and look for, 12 covered calls and look for another cash secured put position. So let's go look for those in Thinkorswim right now. So here we are back on Thinkorswim. And so doing it this way, we have basically saved or been able to sell a covered call for in the money, but since we took advantage of rolling it forward when the extrinsic value got like close to 10 cents a share, we held on to the stock so we could continue to sell covered calls on it. And all right. So what we need to do right now is go to the Analyze tab, make sure BITO select, which it is. Let's get all of these collapsed. All right, so this Friday, and I'm going to start focusing just on the 30 days of monthlies, see if we can just do this monthly for now. My weekends have been getting really busy, so not much time to do this as often. So let's just shoot for, see, that's only 19 days out. Let's go ahead and go, I don't know. Let's just check the prices, and then we'll let that make the decision. Oh my gosh, why did that do that? Let's collapse that again. So the 5th, okay, there we go. 15th and that. We want to just look at those two. I do still like to do the average true range to see about keeping that good. Granted, it's only going to be for the monthly, so, oh, we need to get that up on the screen. Hold on a second. All right, so our cost basis is $25.83, and cost basis with premiums at 22, so we're still a little negative overall. All right, so let's look first. We'll do the covered call first. So it looks like we can do the 19s at the money and get like 72 cents a share. If we go out almost 60 days, we can get almost 50 cents more. I'm going to go ahead and do the 60s for now. I think. See, the problem is if we go out that far and the stock price goes up, then you basically have to hold on to it for longer. So right now you can see in the November 15th ones, there's 72 cents of extrinsic value in it. And for the December 20th, there is $1.11 in extrinsic value. So what you do is you check your positions, daily, most likely just check them once a day, and watch this extrinsic value position. It'll show it to you on the accounts, the activity or the account positions. You can see the extrinsic value over there. And you basically just keep an eye on it. And when it gets close to 10 cents, and definitely when it gets lower than 10 cents, you look to roll that position either at the same strike or roll it to a higher strike. So if the stock price is moving up, say it gets into $25 range, so that's $6 more than it is now, then you might want to start looking to start incrementally rolling it up to try and catch up to it. It might take you, a while, like it could probably take you a year to catch up to it if it stayed at that 25 level, because you could probably only roll it like 50 cents or $1 at a time and still collect enough premium at the future one to offset it to where you're still collecting a credit every single time you do it. So it's not costing you any money other than time. So let's just do this. It's just for example's sake. So for now, I am going to go ahead and just do I don't want to go out the full month. Let's shoot for this 40. Or no, we'll do this one, 33. Okay, I'm sorry being so indecisive. All right, so we're going to do an at the money. We're just going to go for it. And we're going to use the rolling strategy to stay safe with basically not getting assigned. And the only reason we're fearful of getting assigned is because we're selling covered calls below our cost basis. See how our cost basis is $25.83? So we definitely don't want to sell it at 19 and get assigned. We're only selling it at 19 so we can collect the hefty premium. And if the ETF does go up in value, we want to roll it forward and roll it up in strike until at the very least we get up to the 2583. That way we will not be losing any money and still collecting the full premiums. So let's go ahead and left click on this 83, and the mark is 86.5, so we can increase this to 86. And we have 1,200 shares, so we can do 12 contracts of this. So right click, confirm and send. So we will collect close to $1,000 premium and click send. So now that is queued. And we want to go ahead and run a cash secured put, and we'll go ahead and set it for the same expiration to give us, you know, the biggest bang for our buck, I guess. And also to have something on the other side. So we left click on this bid right here, and there's a wide spread right here, which that's kind of crazy looking, in it. So let's do this. The mark, where's the mark at? Oh, right there, 151. This one, considering the spread is so wide, it may or may not fill tomorrow morning, so I'll have to keep an eye on it. But we'll set that to 151, and we'll just do one cash secured put. So we'll right click, confirm and send that off, and there. So now we have both orders queued. We have the covered calls and the cash secured put queued, and we will see how that goes. Let's come back over to activity position. I don't know if I can show you this. Yes. So see, on the activity positions, these orders are queued up with the cells. So we haven't it hasn't actually executed them because the quantities are 0, as you can see. But what you do is, once you're in the position, and so the positions will be showing here, both options, we just come in here like daily and see, you can add the extrinsic column. If this extrinsic value column's not there, you can click on the settings and then add in the column. So I added it in to see that value. And so you just monitor these extrinsic values, see how one's $1.51, the other one's 86 cents. So when this gets close to 10 cents or lower, that's when you would basically click on this, right click on it, and there'll be some other menu options when you're actually in the position, and you'll basically look for the one that says roll the position or create a rolling order, and that'll get you started and pointed in the right direction to actually roll it. All right, so all of the transactions have been tracked. We need to check our dashboard to see if the premiums match, so let's do that right now. Alright, so what we want to do is we want to just drag over our web application. We want to go back to the dashboard, and as you'll see, the cash and sweep up here at the very top is $74,852.23, and the brokerage showing, let me expand this out. Alright, so the brokerage showing right there is $74,852.23, so it matches exactly. So we've been fully reconciled, which is good. That means our Thinkorswim matches our web application. So let's click on the premiums tab just to check it out. Wanted to see how the premiums are doing. So August we collected 700, September went down to 571, and that's because we're not like actively doing weeklies. We're, you know, I'm kind of spreading them out a little bit, but just giving you an idea of how that's going. But yeah, anyway, so we'll just wait to see how it plays out over the next I guess what, 30 days, 40 days, whatever we set that option to, and we will go from there, monitoring the extrinsic value, because if it does start going up, I will want to roll that before the option expires. Otherwise we risk early assignment. But in any case, we'll see how that goes. Talk to you later. I want to thank you for watching. Like and subscribe if you haven't already, and go out today to myatmm.com and get your free account so you can start tracking your own transactions. Thanks, and I'll see you in the next one.